Hello, my friends. This is Hilary, your mortgage coach. Thank you for joining me. Today, I'm going to share with you a process that I use to do a rough estimate on how much mortgage one needs to pay, especially when you consider a house. This video was prompted by a colleague at work who asked me how she can figure out how much mortgage and down payment would be required for a house. I am going to give you a short tutorial on how you can go about it. In Canada, most of the houses are listed on the MLS system, the realtor.ca. What you do is you need to type the city. I'm going to use the city of Sudbury because I don't live there and I don't know many of the neighborhoods. This is more for calculation purposes. Let's click on the first house. This house is $309,000. For you to calculate the mortgage, I would use the calculator. So I'll go down and click on the calculator. And when you click on the calculator, it will show you the asking price. The asking price for this house is $309,900. This is just quick estimate. Obviously, if you need detailed information, your realtor can assist you or your mortgage agent can assist you. For this house, if you're going to put down 5% of this would be $15,495. You would need to pay mortgage insurance of $11,776. This mortgage insurance will be included in your principal. If you are going to put 10%, you would need $30,990. For investors, you would need 20% for a conventional mortgage, and you would get $61,980. And this is the down payment. Of course, you'll have to include your closing costs. Let's go to the calculation. The amortization period, this is how long would you have the mortgage. And normally it would be 25 years for most people. Let's talk of a mortgage rate of 3%. Of course, currently the mortgage rate is around 2% or 2.4%. Let's just use 3%. What you do is you'll just click go. It will give you a rough estimate of your monthly mortgage. If you put 5% down, your mortgage would be $1,449, and if you put in 20%, it would be $1,173. For you to understand the effect of increasing interest, let's say, for example, the interest increased to 4%. If the interest increased to 4% for 5% down, the mortgage will increase to $1,611, which is like $200 more. If you had put 20% down, the mortgage would be $1,304. You can see that you need to estimate before you purchase how much tolerance you have in case there is an increase in your mortgage. It's very important for you to understand how to do this calculation, because at least you will know what to budget for your housing costs. You can do this for any house. Let's say, for example, instead of the house price being $300,000, let's say the house price is $500,000. What would be the mortgage? The mortgage would be $2,647 if the interest is 4%, but if it is 3%, it is $2,382. If you put 20% down at 4%, the mortgage would be $2,146, but with 3%, your mortgage would be $1,930. You can adjust the asking price depending on the location that you are in. This will give you a rough estimate on how much you'll require for the down payment. Remember that you will need the closing costs before you can close and purchase the house. This was just a quick way for me to show you how to calculate your mortgage that you require when you decide to purchase a house. I hope this has been helpful to you, especially this is geared towards new immigrants who have never held a mortgage in Canada and would like to navigate the process. If you need a mortgage, please contact us and we can help you through the process. We can guide you and negotiate good interest rate because we are able to access many more lenders as opposed to just one bank. Thank you very much for joining me. Hopefully you have learned something. You can share this video with your friends. Hopefully we can help many more people purchase homes in Canada. Hopefully guide them through the process of financial freedom and the process of them controlling their shelter costs. Thank you. I will see you on the next video. Bye.